Mr. Market, the emotional investor. Imagine waking up to a market that offers you a chance to buy and sell stocks every day. But there's one catch today: it's wildly happy and offers a high price for everything. Tomorrow it's devastated and offers you those same stocks for next to nothing. Welcome to the world of Mr. Market. In today's video, we'll dive deep into the emotional roller coaster that is the stock market and how you, as an investor, can learn to navigate it without losing your mind. This is a long-form video where we break down the concept of Mr. Market, one of the most important ideas in investing introduced by Benjamin Graham, the father of value investing. In this video, we will explore Mr. Market's unpredictable emotional behavior and show you how to take advantage of his swings without letting him manipulate your investment strategy. By the end of this video, you'll understand how to ignore Mr. Market's irrational behavior, how to stay calm when the market is in a frenzy, and how to spot opportunities when prices are low due to panic selling or excessive pessimism. The birth of Mr. Market. Benjamin Graham introduced Mr. Market in his groundbreaking book, The Intelligent Investor. This concept was created to illustrate the irrational and emotional nature of the stock market. Think of Mr. Market as a business partner. Every day, he shows up and offers to buy or sell stocks at different prices, based entirely on his mood. Some days he's overly optimistic, and other days he's full of despair. Defining Mr. Market's offers are often detached from the real value of the companies. On good days, he believes every stock is worth a fortune, and on bad days, he thinks it's all worthless. The key for you as an investor is to take advantage of these swings, buying when he's overly pessimistic and selling when he's wildly optimistic. The psychological foundations. Mr. Market's erratic behavior is rooted in human psychology. He reflects the collective emotions of all market participants: fear, greed, optimism, and pessimism. This behavior creates volatility, which can make investing seem like a guessing game. But if you understand his emotional patterns, you can turn his irrationality into a profit. Understanding emotional swings: optimism versus pessimism. One of the key characteristics of Mr. Market is his dramatic swings between optimism and pessimism. When Mr. Market is optimistic, he believes the world is perfect, and stock prices soar to unsustainable levels. On the other hand, when he's pessimistic, the market plummets, often to levels that do not reflect the underlying economic reality. These emotional swings are your chance to buy low when Mr. Market is down or sell high when he's euphoric. How market sentiment affects prices. In reality, stock prices should reflect the true value of a company, but emotions often cause them to deviate wildly from that value. During periods of extreme optimism, stocks become overvalued, and during panic, stocks become undervalued. Understanding these fluctuations is essential. For example, during the dot-com bubble, investors were willing to pay astronomical prices for companies with little to no earnings, simply because the market was euphoric. Fast forward to the 2008 financial crisis. Fear took over, and many stocks were undervalued, providing a great buying opportunity for those who understood Mr. Market's behavior. Behavioral biases of investors. One of the reasons Mr. Market behaves so irrationally is because of the biases investors hold. Anchoring, loss aversion, and confirmation bias all come into play. These biases cloud judgment, causing investors to overreact in times of fear or greed. As an investor, your job is to recognize these biases in yourself and others, and to use them to your advantage. Case study: the 2008 financial crisis. The 2008 financial crisis is a perfect example of Mr. Market's emotional extremes. The market was gripped by fear. Investors sold off their holdings in a panic. Stocks like Bank of America, Morgan, and others saw massive price drops, despite the fact that the fundamentals of these companies were largely intact. For patient investors, this was a golden opportunity to buy undervalued stocks, taking advantage of Mr. Market's mood swings. As Benjamin Graham said, "Be greedy when others are fearful." This is where Mr. Market becomes a powerful ally for patient investors. When the market is down and others are selling out of fear, it's often the best time to buy. Mr. Market's pessimism can lead to undervalued stocks, giving you the chance to buy great companies at a discount. The importance of long-term thinking. One of the biggest mistakes investors make is reacting to short-term market swings. Mr. Market can be wildly emotional, but if you're a long-term investor, you can ride out his ups and downs. As time goes on, Market prices tend to reflect the true value of companies. By focusing on long-term goals, you're more likely to succeed while others are caught up in daily market noise. How to identify the right opportunities. So, how do you know when to buy and when to sell? Start by identifying fundamental value, the real worth of a company based on its earnings, revenue, and potential for growth. If the stock is trading below its intrinsic value due to fear or panic, it's a buying opportunity. If it's trading above intrinsic value due to excitement or speculation, it may be time to sell. Practical investing strategies like value investing, dividend investing, and diversification are great ways to take advantage of Mr. Market's swings. Value investing, in particular, is centered on buying stocks that are undervalued by the market. By following a disciplined approach and sticking to your investment plan, you can weather Mr. Market's emotional storms. The importance of emotional discipline. Emotions versus rationality. One of the hardest aspects of investing is overcoming your own emotions. The market can make you feel euphoric during bull runs and terrified during bear markets. But to succeed, you need to cultivate emotional discipline. Instead of reacting to short-term market movements, focus on your long-term goals and trust the fundamentals of the companies you invest in. Real-life examples of emotional failures. Consider the story of an investor during the dot-com crash. Many people saw tech stocks soaring and jumped in, only to panic when the bubble burst. Those who held on to their stocks, however, eventually saw huge returns. Emotional decisions like panic selling often lead to missed opportunities. Mindset shifts for investors. Adopting the mindset of a rational investor is key. Here's how you can do it. First, set clear investment goals and a strategy. Second, avoid checking the market daily. Focus on the fundamentals. Lastly, avoid media hype. Stay informed, but don't let daily fluctuations sway your long-term plans. The role of Mr. Market in modern investing. How applies in today's digital age. Today, Mr. Market's mood swings are even more amplified. With the rise of social media, apps like Robinhood, and constant news updates, emotional reactions can occur in real time. The rapid dissemination of information can create herd behavior and exacerbate market swings. But it also offers opportunities for those who understand Mr. Market's emotional nature. The power of emotional control in modern markets. In this age of instant information, emotional control is even more critical. The rise of meme stocks like GameStop shows how irrational the market can become. But if you can maintain your emotional composure and focus on long-term value, you'll be in a better position than those chasing short-term fads. Mr. Market in the age of retail investing. The rise of retail investors has added a new layer of unpredictability to the market. Platforms like Robinhood and online communities like Wall Street Bets have brought millions of new investors into the fold, often driving speculative bubbles. As a long-term investor, it's important to block out the noise and stay focused on fundamentals. Case studies and examples. Case study 1. Amazon's journey is a textbook example of Mr. Market's emotional swings. In its early years, Amazon's stock was undervalued during periods of market pessimism. Long-term investors who bought during the early 2000s saw incredible gains as Amazon's fundamentals proved. Strong case study 2. Apple is another example of a company that has gone through market extremes. In the late 1990s, it was on the verge of bankruptcy, but during times of pessimism, its stock was undervalued. Those who recognized Apple's long-term potential profited immensely as the company grew into one of the world's most valuable. Case study 3. Tesla's stock price has been volatile due to speculation and emotional trading, but those who understood the company's long-term vision despite the market swings were able to make significant profits. Tesla's story is a modern-day example of Mr. Market's unpredictable behavior. Conclusion. In summary, Mr. Market is an emotional investor who swings between optimism and pessimism. By understanding his irrational behavior, you can avoid emotional pitfalls and take advantage of market swings. Stay calm during times of fear, and be cautious during periods of excessive optimism. Final thoughts. Remember, investing is not about timing the market. It's about understanding its emotional fluctuations and making rational decisions based on long-term value. Call to action. If you found this video helpful, please like, comment, and subscribe. Share your thoughts on Mr. Market below. Have you ever taken advantage of his mood swings in your own investing journey?